One of the fastest ways to tell that someone has become financially successful is when investment opportunities start showing up everywhere. A friend has a deal, a business partner has a deal, someone from the country club has a deal, someone you've known for 10 minutes suddenly has a deal. And the pitch is usually some version of, this is exclusive, this is private, this isn't available to everyone, which sounds really exciting because exclusivity is a very powerful word. It's also a word that has separated a lot of people from perfectly good money. Today, I want to talk about private investments. Not because they're good, not because they're bad, but because many successful people evaluate them incorrectly. And one of the most expensive mistakes investors make is confusing a good opportunity with a good fit. The more successful you become, the more opportunities find you. And that makes sense because people with capital attract capital requests. What starts happening is real estate syndications, private credit, private equity, operating businesses, franchise opportunities, venture deals, friends of friends with can't miss opportunities. And eventually every successful person hears some variation of, you're getting in early. Let's talk about that phrase because getting in early sounds incredible. You know what else was early? Most restaurants, most startups, most failed businesses. Being early and being right are not the same thing. That's why every private investment should begin with one question. Not, how much can I make, but what could go wrong? Most private deals spend a lot of time discussing returns. They spend less time discussing limitations. Let's start with liquidity. You can usually sell a public stock tomorrow. You may not be able to sell a private investment for years. And that matters because liquidity rarely feels important until you need it. Second, valuation. Public investments have daily pricing. Private investments often don't, which means sometimes the reported value is more opinion than market reality. Third, sponsor risk. A lot of investors spend more time evaluating the deal than the people running the deal. The sponsor may be the investment, folks. Not the property, not the company, not the strategy, the actual sponsor. Before investing in any private opportunity, I would want answers to these questions. Who is running it? How are they compensated? What happens if things go wrong? How much leverage is involved? How long is my money locked up? And how do I get my money back? And my favorite question, what assumptions must be true for this to work? Because every investment looks fantastic if you assume everything goes right. Real investing begins when you stress test the assumptions. At Frame, we don't evaluate private investments in isolation. We evaluate them in context. How much liquidity do you have? How concentrated are you already? What does your tax picture look like? What other risks already exist? What goals are we funding? Because here's the truth. A private investment can be a perfectly legitimate opportunity and still be the wrong decision. Not because it's bad, because it doesn't fit, and fit matters more than excitement. The best investors don't collect opportunities, they filter opportunities. The next time someone brings you a private deal, don't ask, how much can I make? Ask, what could go wrong? How long am I locked up? How does this fit my plan? Because the goal isn't finding investments, the goal is building wealth intentionally. And those are not always the same thing. Make sure to subscribe for more planning conversations around wealth, business ownership, investments, and family financial decisions. Take care.